Hey guys, Charles here. Let's do AP macroeconomics. This looks like set one. Set one, a 2021, number two, currently operating below full employment. We know that means a recession. If you're below full employment, identify fiscal policy action the country's government could implement. Obviously, just government spending can either go up or taxes can go down. I'm going to stick with government spending. That's one I would probably choose. Number B, draw a correctly labeled graph of the loanable funds market and show the effect of the fiscal policy action identified on Part A on the equilibrium real interest rate. So we're just drawing loanable funds here, supply of loanable funds, demand for loanable funds. Obviously, it is the real interest rate on the vertical. It kind of helps you know how to label that vertical axis. And then it's just quantity of loanable funds on the horizontal. So here, and remember now, loanable funds is just money in the banks. That's all how we think about loanable funds. It's money in the banks. So if the government is spending, what we should know by this point is that when the government spends, they have to borrow. And the short answer is they're going to borrow from the banks. I know they're selling bonds, but we don't want to talk about fiscal policy and bonds. We want to think only about bonds and monetary policy. So the easiest thing to do here is just to know that whenever the government is spending, they're borrowing from the banks. When you borrow from the banks, what happens to the amount of money in the banks? Well, it has to decrease. So supply of loanable funds is going to decrease here, and that would drive up the real interest rate, right? Less money in the bank implies that the interest rate would go up. And we would always finish out our nicely drawn graph here with maybe QLF1, QLF2. This is what they're really interested in, making sure you tell them what's going on with that real interest rate. And we can see anytime the government is spending, we know they're, oops, if I could spell it correctly, that would help, wouldn't it? We know that they're borrowing. Let's say it again. Anytime government is spending, we know they're borrowing from the banks, and that's going to drive up the real interest rate because supply of loanable funds decreases. We could have shown this two ways. We could have also shown what happens to demand for loanable funds. Let's do it real quick again, just so we can see it and know that you have two options here. College Board will let you choose either one. I'm a supply of loanable funds. I think when the government's coming in, they're taking money out of the banks, but it's kind of both sides of the coin here. Let's think of it like this. When the government is borrowing, when the government walks into the bank and they say, I need $6 billion, what just happened to the demand for loanable funds? Right? It had to increase, right? Because the government is coming in borrowing money. That's going to increase demand for loanable funds. And we can see again that the situation is the interest rate would go up. When that real interest rate goes up, that's what we're looking for, right? Both of these are absolutely correct. When the government walks in, they're increasing the demand for loanable funds. And when they take the money out of the bank, they're reducing the supply of loanable funds. Both of these are absolutely acceptable. You have to choose which one you want to do. All right, C, based solely on the real interest rate change in Part B, what will happen to net exports? And explain. So now we're talking about interest rates here. We know the real interest rate is going up, and it's a foreign exchange question. So this is really kind of a FOREX question. What we know is when interest rates go up, that our currency will appreciate. And you're like, Charles, how did you know that? Well, let's talk about it for just a second. I like to do the FOREX like this. It's the big FOREX in the sky somewhere. We have U.S. citizens here. We have, let's say, Indian citizens here. So we got India, we got the U.S. The real interest rate in the U.S. goes up. That implies that the India interest rate must have gone down. Well, who wants to put whose money in which country? Obviously, Indians want to take their hard-earned rupees and they put their rupees into the FOREX. This implies that the supply of the rupee will increase because they're dumping their rupees. I can't do a rupee to save my life, but anyway, that's off the top of my head, that's the best thing I can do, and that's probably all kinds of wrong. Embarrassing, but why should I? Supply increases, right, of the rupee inside the FOREX. Remember, we're talking about what's going on. These graphs are showing what's happening to the rupee compared to the American dollar. This is quantity of rupees down here. All right. At the same time, they're buying U.S. dollars because they want to put those U.S. dollars into those U.S. banks and get that high real interest rate. So they're buying U.S. dollars, or they're demanding U.S. dollars. So what we know is that the demand for U.S. dollar is increasing, and that's driving up or appreciating the value of the U.S. dollar. This would be U.S. dollars on the vertical, quantity of U.S. dollars on the horizontal, and then it's rupees to dollars. So this is a bit of a multi-step understanding here. Not only do we now need to know what's going on with the real interest rate, which we do, it's going up. That higher real interest rate attracts capital from other countries. They have to buy our dollars to put their money into our banks and get that high real interest rate. That appreciates our currency. When our currency appreciates, that means it's now more expensive for foreigners to buy our goods. So our goods are now more expensive because we have a stronger dollar, right? That implies that our exports are going to decrease, right? Because now our currency it takes more foreign dollars to buy the same stuff. So that means they're going to buy less of our stuff, if that makes sense. Real interest rate goes up, currency appreciates because people are demanding our dollars, trying to get that higher real interest rate. That makes, when our currency appreciates, it makes our goods in our country more expensive. Therefore, our exports have to fall. We would just say next exports are obviously going to decline here, and we'd use all that for the explanation. Stock of physical capital. Well, think about that for just a second. Now, when we say stock of physical capital, now we're talking about people actually producing capital goods in our country. So when the real interest rate goes up, this is going to make investment. Would you rather take out a loan at 20% or 2%? Take out a loan, borrow the money, and pay back interest rates, right? Most people would rather pay lower interest rates. So here we've got our interest rate going up, let's just say to 20%, that means less people are going to take out loans. Investment goes down. This is domestic investment, by the way. We always just write it as investment. Investment goes down, less people take out loans. If there's less loans being taken out, there's less capital formation. We could also call it there's less capital stock. Or we could have said less physical stock of physical capital. All of that's perfectly. And we would just explain it using those interest rates and investment and capital stock of formation. All right, my friends, I think that's it. Any questions? Just send me a quick email or a text or whatever, or leave me something so I can know what's going on. All right, be safe. Bye.